You are listening to Keystone's Stock Talk Show, episode 262. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again this week, in a week that kicked off with more Canadian M&A activity with both Sleep Country and A&W Royalties or Income Fund announcing transactions. I will start by reviewing the idea of behavioral finance and specifically how biases, both cognitive and emotional, can produce poor judgment from investors. Aaron will review the A&W Revenue Royalties Income Fund, symbol AW on the UN TSX, the transaction, whether or not it makes that stock a buy, sell, or hold today. In our Your Stock Our Take segment, Brennan answers a viewer question on Atlas Engineered Products, symbol AEP on the TSX, a profitable small cap that designs, manufactures, and sells engineering roof trusses, floor trusses, and wall panels. The stock performed or continues to perform well, and despite macro headwinds, Brennan will give you his take on the current, future, and fundamental future of the business. Finally, Brett chimes in with his take on covered call ETFs, which have become increasingly popular with many financial institutions, creating more flavors each year. Now let's get right to the show. My co-host, Mr. Aaron Dunn, is here, and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well. What about yourself?
Good. Like we said, a busy week last week in terms of M&A. We kicked off this week and we started with further M&A activity. There was Sleep Country is getting acquired and a transaction with A&W Royalties. So we'll get into specifically the A&W Royalties transaction with Aaron, but there's, we have a poll question as well, unless you guys want to talk about anything you did this weekend. Does anybody care? Probably not.
The only thing I'll say is it's smoky in Saskatoon. I think it's from all the BC wildfire. So I don't know if it's smoky in Calgary as well, but
just a touch, not much.
I was golfing in the haze yesterday. Yeah.
There was some announcement in U.S. politics, the political field last week.
Apparently, I heard.
I'm not sure if anybody heard about that. Yeah.
Mm-hmm.
But it should be interesting to see. I'm sure we're going to get a ton of questions in our client chat session tonight on how this affects their portfolio. Again, over the long term, we're always going to focus on the individual companies, not what the potential of a sitting candidate or party coming into government will do to your portfolio. In the long term, it is often best practice not to dwell on those things.
We and as you said, we get those questions all the time. I personally don't like answering them because my answers are never really satisfactory when it comes to those types of things. But there's really no way to predict. There's no way to say do this because there's been a change in presidential candidate or because one person was elected over another. Like there's no answer that's gonna generate value in the investment decision-making process there. Now, obviously, people, when they see huge events happen around the world, they think like, well, how do I integrate this into my investing? The fact of the matter is, for the most part, you can't, right? Mm-hmm. The investment strategy really remains the same, and that's to focus on good, solid, profitable, growing businesses that have competitive advantages and are well positioned to do well in the good times and do better than the competition in the bad times.
And I remember in one of our webinars, like even Ryan, I think it was Ryan or maybe you, Aaron, went over just the consensus back in the 2016 US election.
The the Hillary trade was
Exactly.
on then at that time. And, because the polls indicated that, across the board almost that, Hillary was going to win, then Trump won. I mean,
Everyone was
after the
saying that the
debate
market was
this
gonna
year,
fall.
after the debate this year, the Trump trade went on. And the first debate, which Biden, most people say performed poorly. The Trump trade is on, and now there's been a change. So, I mean, could you have predicted that potentially? These things, if you're basing your investment portfolio on these rather than just good, solid fundamentals in a business, it's not the way to position a portfolio. So we're just generally going to say focus on the individual investments rather than which party or which candidate will get in, and some supposed bump you think you're going to get in the near term from gaming that. All right, well, let's look at our poll question. Brett's got that. I believe we're talking about M&A here as well.
Yeah, this was a great poll from our favorite viewer, Brennan Habitler. He was just
thanks
curious.
For watching, Mr.
Yeah, thanks for watching. Habitler, whatever you want to. Yeah,
says it right.
I'm not sure if I do. We never know.
I just like to.
So the poll is: have you ever owned a stock or stocks that have been acquired? 34% have not, or no, they have not had any acquired. 15% have yes at a lower price than they bought it at, so they actually lost money on that trade. 46% yes at higher prices than they bought it at, so they made a profit. And yes at some they had below and some they had above what they bought it at.
Yeah, typically from our coverage, you're talking about companies that are in most cases above, and then getting a premium already above when we invested in them or bought them and getting a premium. We had that with HRX last week and HEO just last year. I can recall I did a conference several years ago, and we had recommended the company to clients a few months before, and then we talked about it at the conference, and a month later it got bought out. That was International Road Dynamics that actually got bought out, but by another public company, Quarterhill, which we were happy to sell to and not take their shares because we'd reviewed Quarterhill a number of times. It wasn't all cash offer, but typically it's not going to happen in 2-3 months like it did in that company. But, we do a cash-rich Canadian small cap report where we review every company with a net cash position in the Canadian markets each year. Inevitably, there is one or two companies from that, list of 60 to 80 companies taken over each year. And that's because, again, people always ask, how do you find a company that, is going to get acquired and give me a premium, give me an exit point in my portfolio? Just trying to find that is probably poor investment strategy. But sticking, again, like, it gets boring, and we say it over and over again with a profile of business you can see there out of this that they've got a net cash position. So that just means a good balance sheet. You're looking for a good balance sheet, profitability, and growth. And then that company trading at reasonable valuations can get bought out, and it's typically at a significant premium, which is great. You get exit points via that route, and then you can reinvest that capital.
Yeah, like another example, like there was just a monitor, was Apollo Health. That was like during kind of the COVID. They were selling hand sanitizer. Huge cash position.
Pretty good market during that period.
Well, exactly. And it was a pretty good market. And like, that's why we kept it as a monitor, is we were a little weary of the business. And the stock ended up trading up. We were looking at it and then really coming back down. And then it wasn't until, the stock was at a depressed price that it eventually got bought out. But yeah, just like Ryan was saying, the cash rich balance sheet. Like I ended up voting in this poll as well. And, a cannabis company that I owned, cash rich, profitable, it was taken out. And that's an attractive target to a lot of these, cannabis consolidators who are just burning cash flow and not profitable and have loads of debt on the balance sheet. So, it's nice when they can acquire something with, the cash and profitability for sure.
Yeah, and like we said, we saw 2 more companies with M&A activities this week. I think the Canadian markets, like I profiled last week, traded at a discount to the U.S. markets, and there are some opportunities there, and we would expect, M&A to continue. with the promise of rates going lower. And also, there hasn't been a ton of M&A, so there's just kind of been a vacuum there, and then you start to see movement in that respect, and it kind of comes quite quickly, and you're seeing that right now.
Yeah, and I'll just add, Sleep Country as well was highlighted within our Dividend All Stars as a monitor as well. Before this, it was trading roughly the same price, and that was really our point. Was it was cyclical weakness behind it. So until this M&A came out, you're effectively market return or even slightly break even, depending on exactly where you would have bought.
Yeah, it is very difficult to predict an acquisition like that, but there is some value there. Somebody betting on likely future growth from a company that kind of dominates that market in Canada, but there's always been questions on. Well, recently there's been questions on whether they can grow. Are they kind of saturated in the Canadian market? They're making acquisitions in other areas, ancillary to sleep too. Interesting business, but yeah, you're seeing more M&A activity. M&M activity too. He did just release a signal.
You'd wonder from a transaction like Sleep Country, because we saw that as cyclical weakness that the company was dealing with. They had a strong track record of growth. That growth had slowed. There was actually some declines in earnings per share, but that looked like to be a temporary situation. But you'd wonder why the company would sell itself if indeed it was just at a cyclical bottom, and perhaps the forward growth expectation internally was going to be a lot lower, right? Whereas for a company like Fairfax, they don't necessarily need a lot of growth if they're looking at it from a cash flow yield perspective, right? Because they're just generating cash flow off of investment essentially.
Excellent. All right, let's go. Let's get right into the show. I'm going to look at, I'm going to share my screen here and look at the concept of behavioral finance, and we'll have some comments on it as well. And I'm going to focus on biases. But let's just look quickly at behavioral finance. What is it? Commonly defined as an application of psychology to understanding human behavior in finance and investing. Now, the efficient market theory, which states that all equities are priced fairly based on available public information, is often kind of criticized or debunked for not incorporating irrational emotional behavior. Now, a subfield of behavioral economics proposes that psychological influences and biases affect financial behaviors of investors and financial practitioners. One key aspect of behavioral finance studies is the influence of psychological biases. Now, there are many. I'm going to touch on a few that we see investors and clients kind of struggle through to try to effectively invest in stocks. Now, in the realm of investing, we will define behavioral biases, as systematic errors in judgment, or systematic errors in financial judgment, or imperfections in the perception of economic reality. Now, they're cognitive, like I've said, and emotional biases. Both produce irrational judgments. I'm going to look first at cognitive biases, technically defined as basic statistical informational processing or memory errors that are common to all human beings. Emotional biases originate from the subjective feeling or intuition or impulses. Now, let's touch on a couple of the latter, or emotional biases, to start with, and we can discuss these as I go forward. The first would be loss aversion. Loss aversion bias was developed as a concept by Daniel Kahneman and Amos Tversky in response to observation that I can really pronounce names well, that people generally feel a stronger impulse to avoid loss than to acquire gains. The possibility of a loss is on average twice as powerful motivator as the possibility of making a gain of equal magnitude. For example, the pain of losing $100 is often far greater than the joy of gaining or finding the same amount. You can see there, $10. Losing $10, oh, a cruel world. So he's not that pumped about losing or getting the $10, but just
did you draw
crushed.
Did you draw this?
Did I draw that?
Yeah.
No, that's way too good for me. Let's be honest. All right, and we can talk about loss aversion. We'll talk about these, I guess, at the end. But the next one would be endowment bias. Now, people who are subject to endowment bias place more value on an asset they hold property rights to than one they do not hold rights to. This behavior is inconsistent with standard economic theory, which says that a person's willingness to pay for a good or object should be equal to the person's willingness to sell that same good or object. Psychologists have found that the minimum selling prices that people state tend to exceed the maximum purchase price they are willing to pay for the same good. Investors in this, an example in the world of investing, investors continue to hold securities they own rather than disposing them in favor of better opportunities. Again, this is something we see play out in real time with investors, and it hurts their returns over the long term. Now I'm going to talk about a couple of cognitive biases. The first would be overconfidence. We define this generally as unwarranted faith in one's intuitive reasoning, judgment, or cognitive abilities. Investors tend to overestimate both their predictive abilities as well as their precision of the information that they have been given. They believe they are smarter and have better information than they actually do. An example of this, well, that would be an investor getting a tip from either an investment advisor or from a TV program, or they've read something on the internet about a stock and they buy it based on his or her perceived knowledge advantage that they have. Again, this is something we see all the time. Investors in our chat sessions, we get emails about it all the time. Get a tip from BNN or CNBC. It is just a small piece of information on the stock. They've not really done the requisite informational discovery or the due diligence necessary to invest in the company. They think they have a knowledge advantage, but it's not really there. Now, the final bias is a little more nuanced, but I will give an example at the end. It is called representativeness. It's a large word. There's going to be a lot of words in this slide. But representativeness, I'm going to define it here. Because human beings like to stay organized, they develop over time an internal system for classifying objects and thoughts. When confronted with new circumstances that may be inconsistent with existing classifications, they often rely on what we call a best fit process to determine which category should house and form the basis for understanding these new circumstances. This perceptual framework provides a practical tool for processing new information by simultaneously incorporating insight gained from past experiences. Now, sometimes, however, new stimuli are representative of elements that have already been classified, while in reality, there are differences. In such an instance, the classification reflex is wrong, and it produces an incorrect understanding of the new element that often persists and biases future interactions with that element. An investing example, an investor may be presented with an investment opportunity that contains some elements that are representative of a good investment. The investor's desire to mentally classify that investment opportunity may cause him or her to classify what is really a poor investment opportunity as a good one, based on the few elements that are representative of a good investment opportunity. On the flip side of this, we have to act to prevent this from entering into our own bias or analysis when we're looking at a company. I'll give you an example of that. When we initially, 6-7 years ago, came across a company called Dynacor, it was called Dynacor Gold at the time. We have an aversion to mining exploration companies, generally speaking, but we still look at all companies, and it is a good thing that we still continue to review all these companies, because we found it was less a mining company than an industrial ore processor, a great business. And if we had used that bias, or that bias had entered in it, this company may have not made it into our coverage. So you have to try to eschew that bias and to continue, in our research at least, to look at that company and find out, what does this business really do? And let's not have that bias in there because of the name of the company. All right, that's going to finish off my segment on biases and behavioral finance. Any comments, guys?
Yeah, I'm really glad that you did this as a segment, because behavioral psychology and really studying it like a science is something that investors don't do enough. I mean, when we think
Yeah, I agree.
about, you know, what you do in terms of like studying investing in your portfolio, it's usually like, well, I'll research individual companies, or I'll research like macroeconomics or economic indicators, or how to like calculate financial ratios, what they mean, interpretation. But in a lot of cases, investors in some ways, the biggest risk that they face is really themselves in some ways, right? Because investors, and this is all of us, but human beings are prone to making certain mistakes and not necessarily knowing what those mistakes are, or that they are mistakes, and then repeating them over time, right? And one of the things that behavioral psychology does, and then looking specifically at the different biases, is it gives you more self-awareness over what you're doing, right? So when you study these, you start to think about your own actions and look at what you've done in the past, and think about like, okay, like, yeah, I was, overconfident there. There was loss aversion here. There's representativeness here. And like that gives you the opportunity to become a better investor, and probably in a more powerful way than learning, a little more about ratio analysis or macroeconomics.
Know the basis of those things, the basics of those things, but coming to grips with and being self-aware as to where your issues lie. And this is something that when we talk to individual investors, we can do to help coach them kind of in those areas. Be it loss aversion, representativeness. I can't even say the word, but it's too large. But it's so many things that enter into your buy decision or your sell decision or your decision to continue to hold, that if you are self-aware, like Aaron said, if you do know that is something that you have suffered from in the past, you can take a deep breath kind of and say, am I looking at this buy, sell, or hold decision the right way? And they are things that almost every investor struggles with. They have some biases. I mean, every human being has a bias when processing any information, but in investing, you certainly see it.
Then yours is bigger than
than most. You have worse problems, probably. Yeah, that's overconfident right there, probably. If you think, no, I have no bias, that's ridiculous.
And that's why I think like having like a trading journal, or investing journal, it's just call it trading journal just as a term, but just to be self-aware, get your what was I saying in 2018 about this investment, why did I like it, and like track your thoughts on that investment over time. And then I had two other points, just like on loss aversion. Like I have said this before on the podcast, but it's not just a stock market, it's a market of opportunities, like Ryan was basically saying in his slide. And if an investment does go sour and the opportunity is no longer there, just allocate the capital to a better opportunity rather than, continue to hold a stock which doesn't present an opportunity any longer. And another one that I really like, and this is, I love quotes, and this relates to overconfidence bias. And this is a quote from Mark Twain that I love so much because it represents this so much. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And that is so true when it comes to investing is, if you're, piling in, 30, 40, 50% of your portfolio into a stock because that it's going to pay off, well, that's going to potentially get you in trouble. So, just keep that in the back of your mind if you are doing something like that.
Yeah. And it just, with all of these psychological biases, it's an art, not a science. There's a science to investing too, but there is the art of dealing with your psychological biases in investing. And even when you have loss aversion, it's not always as simple as, okay, this stock is down, so I sell it. When we had the pandemic and stocks went down, like that was a time to steady yourself and buy. And you have to learn from those moments. And not every stock to buy, but there was some great opportunities out there. So, you're down 20%. You don't just recycle that into something else. You look back, if you had that journal, or if you look back at one of our reports, or you reach out to us and say, look, I saw this stock go down 20, 30%. Has your fundamental investment philosophy or your fundamental thesis for investing in this company changed. If it hasn't, then we're going to buy more, because that's the time to buy more. And those are your game kind of portfolio game changing opportunities if you can get a company that on sale that is a great business. All right. Should we move on? We can talk more. There's more we could go into with behavioral finance. I think it would be interesting I think it's an interesting topic to go on.
I don't
So
know. One
we'll
thing
continue.
that maybe I'll mention is, if people are interested in us putting together some type of a behavioral finance course, like a mini course, post some
Let's do
comments
that. Yeah.
or send us some messages, and that might be something that we'd consider.
Yeah, for sure. I think it'd be great. All right. I think we're moving on. Aaron's going to touch on some of that M&A activity, which is great on A&W and the transaction that was proposed just this morning. Probably it was yesterday if you're looking at this, because we posted the next day, I believe.
Yeah, so very, very interesting transaction here. A&W Revenue Royalties Income Fund. So this is a company that we had coverage on in our income research a while back. We've updated it, since then. I believe I had it as a year stock our take a couple of months ago. And we've always thought that it was an interesting business. We've liked the business as a yield play. One of the things that I did mention on the year stock our take is that the growth had slowed quite significantly recently, and we weren't expecting them to achieve some of those double-digit growth rates that they were able to achieve in the past. But essentially, what they are is they were established to invest in the trademark of the A&W brand and the restaurants across Canada. So they essentially, they're royalty income funds. So they receive a 3% royalty on the gross sales of A&W restaurants in the royalty pool, which as of the end of Q1 of this year was 1,047 restaurants. And I think that they've added a couple few since then. But we'll look at the company here. So symbol AW.UN, it's trading right now at $35. It's about a $512 million market cap company. And today it is yielding 5.5% income yield. Now, big news for the shareholders of the company just recently issued today. And that is the proposed combination of A&W Food Services with A&W Revenue Royalties Income Fund. So just to kind of explain how this works, A&W Food Services, this is the corporation that owns A&W, owns the brands, owns the restaurants across the country. A&W, they're not a publicly traded company. So the public cannot invest in A&W Food Services. The publicly traded company is A&W Revenue Royalties Income Fund, which is AW.UN. So this is the stock that invests in the trademark of A&W restaurants and gets that 3% gross royalty. So a proposed combination of these two entities. Let's look at some of the details of this proposed transaction. So they're looking at essentially combining the two entities into a simplified traditional corporate structure. So there will be no AW.UN post-transaction. It would just be one company. The name of the new company would be A&W Food Service NewCo. NewCo would expect to pay an initial quarterly dividend at the same rate as AW.UN. So that's currently equivalent to $1.92 annualized per share. The transaction is expected to close in October. It's still subject to customary closing conditions like regulatory, court approval, and then also shareholder approval. I'm not seeing any issues with this. I'm sure they're going to get the shareholder approval, and I wouldn't see any reasons why they wouldn't receive regulatory approval as well. So A&W unit holders right now can either receive $37 per unit in cash, or upon closing of this transaction, they would receive one common share in the NewCo company. And this cash offer represents a 30% premium to AW.UN unit holders based on the price right before the transaction was announced. So when we look at a 3-month stock chart, we can see here 23% jump in the share price in a day based on this transaction. So that's a pretty nice 1-day gain for any of the AW.UN unit holders. However, when we look at a longer term stock price, let's look at the 3-year stock chart here. We can see that this really just brings shareholders back to where the unit price was about a year ago, and still well down from the highs that AW.UN achieved in 2022. Now, the company has released some projections in terms of what the combined entity would look like. So they're looking at same store sales over 3 years at about 3 to 5% per year. Some growth, about 2% to 3% growth in the number of restaurants in the network. So overall, they're looking at annualized sales growth in the range of 5 to 7% per year. So that's not bad. Moderate growth. We wouldn't necessarily expect this to be a major growth company here. And then as well, some growth in adjusted EBITDA, roughly in line with the revenue growth. So the combined entity based on 2023 numbers would have adjusted EBITDA of about 91 million. They're targeting net leverage, so net debt to EBITDA leverage of 3 times, which is a reasonable ratio, certainly for a restaurant business. There'd be about 24 million shares outstanding at the end. So the current unit holders of AW.UN would own 41% of the business. Important to understand here is that A&W Food Services also owned a significant stake in AW.UN, so that 41% is excluding A&W Food Services. And the current shareholders of A&W Food Services, again, this is not a public company, but it still has shareholders. They would own 59% of the new entity. So what I wanted to do here is just do a little valuation analysis on the new co-company here. We're looking at an expected dividend of $1.92, expected shares outstanding of 24 million shares. So when it actually starts trading on the market, well, we don't know what the share price is going to be. We do know what the dividend is expected to be. So if we're going to run a couple of scenarios here, I would say that reasonably speaking, we would look at the market dividend yield once it starts trading to be anywhere from 4 to 6%. 4 on the low end. I'm not sure if it's going to quite get there. Probably 6 would be close to the high end. So based on the expected dividend and what we would expect to be the dividend yield range, if it is trading at a 4% yield, then you'd be looking at a $48 unit price or share price post transaction. Now, based on the growth rate and where other dividend stocks are trading right now, I don't think the yield is going to be that's a little low, 4%. Likely it's closer to the 5% range, which would put the share price at about $38.40, just slightly above the $37 that AW.UN unit holders are being offered here. It could trade at a higher yield if investors see a higher level of risk, or they're unenthused by the growth projections, or perhaps if the company makes a couple of missteps early. So it could trade at a higher yield. And if it's at 6%, you'd be looking at a share price of $32. Now, in terms of valuation on an EV to EBITDA basis, so I'm going off of the midpoint of 2025 expected combined EBITDA, and I'm also assuming a leverage ratio of 3 times. You would be looking at a share price of $48. You'd be looking at EV to EBITDA of 14.5 times. At the $38.40 share price, 12.2 times, and at the $32 share price, about 10.7 times. Now, the only really close comparable in Canada would be Restaurant Brands, which trades under the symbol QSR, both in Canada and the US. So Restaurant Brands right now is trading at an EV to EBITDA multiple trailing of about 14 times. Now, this isn't a perfect comparison. So Restaurant Brands owns Tim Hortons, they own Popeye's Chicken, they own Burger King as well. Far larger company, globally diversified. It's had a better growth track record. On the other side, it does have a much more leverage on the balance sheet. Think about 6 to 7 times net debt to EBITDA. So there's some gives and takes there, but generally speaking, I would not expect, given the projected growth, the new A&W to have a higher valuation than restaurant brands, more than likely it's around that 14 times EV to EBITDA or lower. So I'm really saying I'm really thinking that probably a 5% yield, 12% EV to EBITDA is probably what we'd be expecting here, which would put the share price roughly around where the takeout offer is at $37. So our take on this transaction in Newco, I mean, the advantages are there is potential for a moderately higher growth rate. Another thing is that the standard corporate structure may make Newco more accessible to investors. There are some institutional investors that can't invest in income funds. There are some non-institutional investors that just don't understand them. So just having a standard corporate structure definitely makes it just a more understandable, accessible business. There's likelihood for the dividend. Well, there should be a dividend tax credit on the dividend as well. So that would help. The negatives would be that the AW.UN investors are losing the revenue royalty structure. So one of the things that we always really liked about AW.UN is that it didn't have exposure to the operational risks of running a restaurant. They were just getting money a cut of the revenue. So, labor costs, other costs associated with equipment, with rent, those types of things, real estate. That wasn't really factored directly into what AW.UN was getting for its revenues. But losing that royalty structure, now it's just a standard corporation. They have all of those risk exposures. So certainly the level of risk is higher given the exposure to operations. My take is, really, I think that investors could go either way with this. Either taking the cash payout, or if they want to be invested in AW or the new A&W, then they can continue on with the company. I would just say I'm not necessarily seeing a lot of great value here. It's not, I don't look at Newco and think like, relative to the growth, this is a great value proposition. I'm thinking it's probably more fairly valued. $37 is a nice payout. Certainly it's rewarding the A&W.UN unit holders. We've seen A&W.UN's price much higher in the past, but again, growth was higher in the past. So, that's part of the reason why. And, really looking forward, we would be expecting a single digit growth rate. Now, there's always the possibility that A&W expands, perhaps outside of Canada, perhaps into other brands, or does other types of partnerships. But those are really unknowns right now. Based on what I'm seeing, I'm seeing, more or less a fair valuation, but then there are some unknowns as well with the new business. So probably if I wanted to be invested in the new company, I might look for opportunities depending on what, my capital gains tax would be on the $37. I might just take that, look for opportunities to reinvest it. If I'm happy to be in a business, if I like the A&W brand, I would just continue. I would just continue to own those shares. But yeah, I mean, really, it's probably a reasonable deal for AW.UN unit holders, and certainly it'll be an interesting story to follow going into the future.
Yeah, it is interesting. It looks like they kind of did a similar type analysis to price where the takeout, the all cash price is. Again, I would be in agreement that that doesn't, unless they've got future plans to make acquisitions to grow the business beyond. I mean, it's a decent same store sales growth rate, but in the past, like you said, it's been higher, which made it more attractive.
It was in the double digits for years, upwards of like 12, 14%, right? Which we always felt was unsustainable. I mean, that was really high.
Yeah.
It's what they're projecting is decent. It's not, overly compelling, but it's moderately, reasonably decent.
So to probably trade at 14.5 times or 14 like QSR does, they're going to have to add another growth element, or add an acquisition of another, or expansion somewhere, I would think. And maybe that's coming. Again, I didn't see anything in the presentation about that, but maybe there is something coming further. All right, well, let's move on to our next segment. I think Brennan is taking that one, aren't you, Brennan? You're doing your stock, our take on Atlas.
That is correct. So yeah, we got this question from Steven on Atlas Engineered Products. So he says, Atlas Engineered Products, interested in your take on the company's balance sheet and how they are executing on their strategy of consolidating companies operating in their same business segment of engineered wood products. So Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of about $1.41 and a market cap of around 97 million. Now, the company designs, manufactures, and sells engineered roof trusses, floor trusses, and wall panels. The company also distributes a range of various engineered wood products for use by builders of residential and commercial wood framed buildings. And these include single family homes, townhouses, multi story wood framed residential buildings, commercial buildings, and agricultural structures. And the company's strategy is focused on profitability and organic revenue growth within its current markets, and the pursuit of a roll-up acquisition strategy to consolidate similar companies operating in the truss and engineered wood products industry across Canada. So I covered Atlas back in February of 2023. And at that time, my overhanging fear with the investment case was the comments from the CEO during our analyst call when he said that money being very cheap and interest rates going above 4% could potentially disrupt the business's growth. This is when, interest rates were below 4%, significantly below. But the stock has continued to, of course, climb approximately, 50%. Since I covered the stock last. So let's dig into what has taken place since. Now, looking at some operational updates, the company has made 8 acquisitions since going public in 2017, with the most recent acquisition in August of 2023 when it acquired Leon Chouinard, hopefully I'm saying that right, located in New Brunswick. And the company is a manufacturer of roof trusses, floor systems, and wall panels, and a supplier of engineered wood products. The focus of the acquisition is to grow the company's national footprint, and the company paid about $29 million with a price to earnings multiple of about 4.6 times earnings. Now, on June 26th, the company announced it closed a private placement for gross proceeds of about $14.5 million, issuing 10.7 million shares at a price of about $1.35 per share. And the company intends to use the net proceeds of the offering for the purchase and installation of robotic automation equipment at facilities located in BC, Ontario, and New Brunswick, along with additional equipment and upgrades required to incorporate the robotics at these locations. And following the private placement, I believe the company has approximately 69 million basic shares outstanding. So it is a little bit different than this graph that I have up on the screen, just because it actually hasn't hit the quarter yet, or the upcoming quarters yet. Now, this is kind of a nice segue into the next operational update, as on June 6th, the company announced that it accepted proposals for the installation of robotic automation equipment at 3 of its locations, and that it has made initial deposits to secure the installation of equipment. Now, the robotics installation is expected to have a total cost of just over US $7 million for all 3 locations, and the robotic automation is anticipated to double the board foot output of roof truss manufacturing while providing potential significant cost savings. Now, I saw an estimate from Cormark here, which placed the estimated robotics initiative to cost about 25 to 26 million Canadian over the next 2 years, with a new greenfield facility accounting for about 15 to 17 million. And the investments expected to increase truss manufacturing capacity at about 400% at High Tech. I believe they made that acquisition in 2022. 100% increase at LCF, which is the last acquisition they made that I just briefly went over, and 50% capacity increase at Clinton, with as well expected lower operating expenses and approximately 50% reduction in labor costs. And, like I said, the robotics upgrades are expected to be completed over the next 2 years. So moving on to the recent financials, Q1 of 2024 being the most recent, revenue decreased about 5% to 9.1 million. This was primarily due to material price stabilization at a normal level, which was less than the 2 prior years, and a more competitive construction market created by interest rate hikes by the Bank of Canada. And the company does not anticipate that increased interest rates will affect sales long term. However, sales may continue to be affected in the short term as the market stabilizes and everyone waits to see if interest rates will be lowered by the Bank of Canada. Now, adjusted EBITDA was down to about 247,000 compared to 1.7 million for the same period last year, and net loss was a loss of about 993,000 or 2 cents per diluted share or basic share, I believe, compared to a gain of 543,000 or 1 cent per share for Q1 of 2023. And the decrease in adjusted EBITDA and net income was primarily due to lower revenues in a market with reduced housing demand and reduced gross margins due to the increased market competition and seasonality of the LCF acquisition over in the East. Now, looking at the balance sheet, they had about 7.2 million in cash with 30.9 million in debt and leases, providing a net debt position of about 23.7 million. And just remember, this does not include any cash from the recent equity raise, but I will say that the trailing net debt to EBITDA multiple has climbed, as it was under 1 times as at February of 2023 when I looked at it, but is now up to about 3 times trailing EBITDA. Right now, I really think that the business is trading near fair value at over 40 times earnings, 15 times EBITDA, and about 28 times cash flow. But given the market is anticipating the recent investments to propel the financials over the next 2 years, and just for a reference point, in February of 2023, the stock was trading at about 6 times trailing earnings. But again, given these investments, it is looking like the financials and potentially earnings are going to grow over the next 2 years, if management can execute, of course. Just looking at the outlook here, management indicates that markets have been very competitive in 2023, and this is expected to be competitive in 2024, given, again, rising interest rates, which have affected the housing market and the company's near-term growth. But the company notes that it recognizes the need to be ready for a potential significant increase in demand if interest rates decrease during 2024, given the number of homes still needed to be built to support Canada's population growth. Now, to conclude, so I guess the first question is why has the stock continued to climb despite its weaker financial results? Well, number one, I would say, is due to the increased sentiment from capacity expansion, utilizing robotics, and the ability to reduce costs. And I would say number two is, increased sentiment just because of the shortage of Canadian homes, as there definitely needs to be a significant increase to meet the population growth in Canada. Now, fundamentally, the business remains pricey on trailing numbers, but if over the next couple of years it can fulfill its capacity enhancements and lower costs, the forward financials and valuation multiples will appear much better. Now, overall, I think that Atlas is a good business. Debt may be getting a little elevated, but I don't think that it's crazy. But even if it is unable to grow in its current markets as well, it will have the additional capacity to expand geographically. And whether I think that it's a buy, sell, or hold, I think it really comes down to whether an investor believes that Atlas will be able to fulfill their new upcoming capacity and capitalize on the potential cost savings, which could grow earnings over the next few years. But just like Hattie had said to us, that's the CEO, previously, elevated interest rates could disrupt the company's near-term growth, which, of course, appears to be transpiring. And, we don't know how long this will last. Of course, interest rates, we were anticipating them to go down, but we'll see. So, generally, I think that it will be worth it to jump on a call with management to kind of get some more insight on the potential cost savings, strategy, and ability to fulfill their capacity that they're adding, and for us to get more color on the current market environment given the elevated interest rates. So yeah, I'll reach out. We'll get on a call with them, and we'll update our clients.
Yeah, I mean, we think Atlas is an interesting story. I think you did a good summary there. The long term Sentiment, the need for Canadian housing is there for sure. But I would be worried in the short term. I mean, the markets right now overall are pretty buoyant across the board. Small caps have started to be recognized. So, I mean, Atlas is kind of getting a benefit of the doubt right here in the current market climate. Current fundamentals might not justify the current price. People are betting on the future. If the market were to shift, I don't know if I would be wanting to hold a company that in the near term faces macro headwinds and is expanding in that environment, has increased debt, and cash flows are lower. The market, if it is negative sentiment overall, can look negatively on a company like that in the short term, and it can happen fast, right? So typically we are wanting to combine good current fundamentals with the prospects of future. I think there's good prospects in the future here, and I think the company's doing a lot of interesting things that could position it well. But is there some risk in the short term if you get a poor overall market sentiment? Yes, I would say based on the debt levels and the recent quarters, for example, where you have lower results year over year, and no sign of that changing short term. Mm-hmm. So yeah, I think if there was negative sentiment in the markets, you could get a cheaper price. I'd just be waiting on the sidelines right now. But it's done well. The share price, the last quarter.
Yeah, I mean it's not like at the end of the day, the company's not worth 47 times earnings. So people are betting that earnings are going to be going up significantly over the next couple of years. Now, that may happen. I think that there's good likelihood, as you guys have noted, but all of that, like a lot of that is already factored into the price, obviously, because the current fundamentals are lackluster, right? It really comes down to, well, what is the future growth? And now you're already paying for some of the future growth without even really knowing for sure what it is. I mean, the best opportunity is when you find companies with future growth, whereby that's not yet factored into the price. And, that's not easy to do, but that certainly, there are opportunities that pop up where at least not so much of it is factored into the current price. Interesting company, though.
Yeah, just to give a bit of context on the pricing is for 2023, they had $10.5 million in labor costs. If you take half of that, like they were saying, 50% labor costs, that's $5.25 million in savings, which ends up about $4 million after tax, which puts it about a 13 PE. So just the savings.
That would be reasonable. So
and that's reasonable expectation.
But again, that's the thing. Can they fulfill the capacity?
Can they do it? And that's what you're risking.
Yeah.
Exactly. And that's why I think that it's worth, reaching out, jumping on a call. I mean, Hattie has always been a very straight shooter from what I remember. I mean, again, even in his, what could derail the story? Well, near-term growth, if interest rates go above 4%, well, it's exactly what happened. I mean, despite the stock continuing to rally, but, he's always been a pretty straight shooter with us when we jump on the phone, which is good.
Yeah, for sure. All right. Well, we're going to end that segment to move on to our final segment. Brett's going to look at covered call ETFs.
Yeah, so covered call ETFs, they've just been increasingly popular. We've been getting more and more questions on them. More advisors have been recommending them. More ETFs have been created. More fund managers are pushing them. So it's really, should you even consider them? Are they useless? Are they great? Are they amazing? And I'll get into that. So they come in various forms, but we can really look at the commonalities and the general structure of them. It is like a normal ETF, but then on top of it, they sell call options against them, against the underlying assets, which can vary between stocks. They can do cryptocurrencies. They can do gold. They can really do anything that has options traded against them, but the most common is a various stock index, whether it's the S&P 500, the NASDAQ, the TSX 60, the Russell 2000, or like we'll look at in a minute or two, the big six banks. It has to be really something like that. The way the covered call ETFs work is the same way covered calls really work on individual stocks, except it's against those basket of assets. Essentially, you give up a degree of upside price increases for a period of time in exchange for a premium or a cash payment to you at the time of the sale of the call option. The ETFs might use terminology in their description, such as covered call, or things like enhanced yield, high yield, and so on, things like that. So if you are seeing those descriptors, that might be what they are doing. Covered call ETFs, they do have some limitations. The requirement for covered call ETFs is they have to have an active options market, which does limit really the potential underlying. For example, you have covered call ETFs on those indexes, S&P 500, TSX 60. As those indexes, they have active option markets. But if you wanted specifically a covered call index on Canadian small cap stocks, you're really out of luck. You're not going to have those. If you've looked at Canadian option markets as a whole, they're generally pretty illiquid, and then they're just non-existent. They are not even exchange traded for small companies. However, there do exist covered call ETFs on more liquid stocks in the Canadian market with liquid options such as the Canadian Big Six banks, and we'll get into that one in a minute, like I said. Also, the big discrepancy between some of these ETFs is whether they're actively or passively managed. So passively managed ETFs will use a systematic approach to their option writing, meaning it follows really a rule-based system, selling options at a certain out-of-the-money percentage for X length of time. So maybe 1 month, it might be 3 months, it might be a year out. And they'll use a very strict rule-based set. Or you have actively managed ETFs, which are very discretionary and are less strict when it comes to the manager's choices. So what I mean by choices, they may include things like the strike price or the out-of-moneyness of the option. So how far is if you're trading something at $100, are they going to choose to sell it at 105, 110, 150, and so on? And as well, then the amount of fund that is actually covered by option. So you don't need to necessarily write covered calls against all your underlying. It could be only 50%, which is very common, or it could be 100%. And as well, some of these covered call ETFs, they actually use leverage on top of it. Normally it's quite minor leverage. It'll be anything between one times, which is unleveraged, or 1.5 times, which is an additional 50% leverage on top of the usual amount of being unlevered. So the general trade-off between actively managed and passively managed is that the actively managed funds have really the goal of beating their covered call index, either through lower volatility and or higher returns. But they likely have higher fees as they're doing more work towards it, and they won't always even outperform their underlying index. The easiest way to see really the pros and cons of covered call ETFs is to really compare it to a standard ETF with the same underlying but no derivatives being used. So compare an S&P 500 covered call ETF to the SPY ETF, the most common ETF in the world, or the most commonly traded, I should say, the most liquid as well. The benefits of covered call ETFs are being an income strategy. The funds commonly distribute those premiums and potential dividends from the underlying. They have reduced volatility as you are selling call options, which reduces your sensitivity to the underlying stock or index. Normally, you can see that if you are looking at a covered call for an individual stock, you normally see it expressed in delta. So if you sell covered calls, it might be a 0.3 delta. A stock will have 1 by default. So then you end up with a 0.7 delta, which means you're only 70% sensitive to the stock price movement. Overall volatility is lower. You don't really need to dive into that deep, especially when you're just looking at the ETFs. It does have as well downside protection compared to non-covered call ETFs, as you collect that premium by selling the potential upside, meaning in a scenario where the underlying is either flat or down, you'll either receive a positive return or a lower negative return compared to that standard ETF. In Canada, covered call ETFs are generally just tax efficient. They're taxed capital gains, whereas in other jurisdictions, options might be taxed income, a standard income, which then is less tax efficient than compared to capital gains. Switching to the cons of covered ETFs, reduced capital upside. In a strong bull market, a covered call ETF will drastically underperform the non-covered call version of an ETF. Only limited downside protection. Unlike a protective put, you only receive a premium, which will mitigate the downside risk. But if the underlying really collapses in price at a fast rate, like if you look at the COVID drawdown in 2020, the premium protection will only be a drop in the bucket of what is actually in the downside. The faster the price increase is, the less useful really a covered call is as a hedging tool, as it doesn't have that time to have the premiums decay and really give you that premium protection. Covered call ETFs as well, they have higher fees compared to your standard ETF. The degree of an increased fee largely depends on the exact management style as well as the complexity of the call option strategy deployed, as there is variance in the strategy deployed. So quickly looking at the Malville Bank ETF CBNK on the TSX, which is one of our viewers asked about, which was prompted this discussion. The fund targets a 7% annual yield with additional capital growth opportunities. Like all covered call ETFs, it will have some sort of capital gain, and then it will have some sort of distribution goal. The underlying is the big six Canadian banks, ranging from 14.2% to 18.3%. So nearly equal weighted. Really, they're an equal weight benchmark with slight discrepancy, and that's very common with actively managed funds. But they deploy a 1.25% leverage, meaning they are using margin loans to amplify returns, as well as losses. And the benefit really, the additional benefit is they can write more call options against that additional stock as they are leveraged. The ETF has a current yield of 9.63%, with distributions being $1.69 since its inception in March of 2022. As well, the ETF has a management expense ratio of 0.65% or 65 basis points against the net asset value or NAV, which is higher than what if you were to have something that is the same asset compared to this. However, since the inception of the ETF in March of 2022, the fund has declined in total value, which includes distributions of 6.3%. If we can compare it against an equal weight bank ETF of the big six banks of HEWB, the underlying is effectively the same until the active management comes into play. The total return for CBNK is a negative loss of 6.3%, whereas HEWB had a positive return of 1.9%. And these are total return figures, by the way, so they include distributions. So overall, the covered call ETF CBNK had actually underperformed a comparable investable ETF. When sometimes you're comparing to indexes, those indexes you can't really invest in. Well, here is an investable choice. You have a similar ETF, and yet it is underperformed in a relatively down to flat market, which is where these are meant to perform. And this is largely due to the leverage nature of a covered call ETF in this case. So moving on, I'll just really close it off with some general thoughts. The most important part of a covered call ETF is still the underlying. It's still going to drive the risk and returns. Options are ultimately a strategy which alters the risk and return, but does not overhaul it. It does not change it drastically. It just kind of pokes and tilts the risk reward scenario. If you do believe in the efficient market buy hypothesis strongly, which you're a passive investor, that's likely what you do believe or what you are relying on. Covered call ETFs will always underperform due to the higher fees. This effectively means that if you are a purely passive investor, you have no expectation to beat the markets, just stick with a normal ETF. That is due to the higher fees. Holding all else equal, although I don't believe in the efficient hypothesis theory in a strong manner, if you do believe that you are a passive investor not trying to beat the market, covered call ETFs will underperform. That being said, there are specific cases due to temporary market conditions or the belief of that, where covered call ETFs can be effective. But if those cases do arrive, you can probably just sell covered calls on your own accord and do that on a discretionary basis, be your own active manager instead of relying on one of these ETFs. And lastly, just to drive the point home, here are a couple more examples of covered calls underperforming. Here, XYLD is an S&P 500 covered call ETF. Comparing it to the index, it's underperformed by about 6%. First, comparing 7.2% average return compared to 13% over its time period since inception in 2022. And even comparing without the fees, the transaction fees, the tax, and all that, which you can't avoid, even though many of these indexes, they'll just ignore them, it's 11%. So even the covered call strategy, comparing that to a normal ETF, it underperformed. So if you are a long-term holder, why would you be using a covered call ETF? And then we can look as well for the TSX 60, comparing two indexes, so they ignore those taxes, the transaction fees, even though you will have those in the real world. If you want to compare like to like, the annualized returns over 10 years were 6.5% versus 7.8%. They had brief periods of overperformance, but when you are looking at these long stretches of time, these covered call indexes, even indexes without including the higher fees, will end up underperforming over time as you are taking off risk. So just generally, if you are a long-term holder, just get the standard ETF. Don't get fancy.
It's interesting. It looks like if you are going to hold a covered call ETF, you have to predict, to be successful, predict a specific set of market conditions are going to be upcoming and have it invested in that ahead of time. You probably have a better strategy that you could use than that as well. So again, I mean, that's just the data that you put out there in terms of how they performed over the long term. And they've been outperformed by a far simpler product. If you want to,
yeah, exactly. And if you do have those
better.
Yeah, if you do have those views, you're probably a sophisticated investor to the point which
you can
you're
use
capable of
other
selling the
strategies.
options on your own. Yeah,
exactly.
Yeah. Interesting. Aaron, you're muted. Sorry. You're muted, Aaron. Sorry, man.
Or you just think you're a sophisticated investor. But I think that this goes back to Ryan's segment on behavioral psychology. I mean, here we have this category of asset that looks very attractive because they pay these high yields. But when you look at the performance over time, they've actually underperformed after fees and taxes. They've underperformed simpler assets, right? So that yield is really just an illusion. It's an illusion that's created likely to encourage people to get involved because they see, I can, make a 10, 15% yield in some cases. But, one of the
unit price declines. We've seen it for years.
Exactly.
Right?
And one of the things that I've read is that like the yield that you're getting now is basically you're getting that because you're giving up stock price returns, like appreciation from the underlying portfolio. So it's not like you're getting this yield. It really is kind of like an illusion, right? Like the misdirection that a magician would use, right, in one of their shows. So yeah, it's not, generally speaking, I mean, we find the leveraged ETFs, the covered calls, the more complicated products don't really add value to investors. Err towards simplicity.
But they do give vehicles for the investment industry to charge you more.
Oh, so they're brilliant for that.
Isn't that amazing?
Brilliant for that.
They're great at that. The fees get to be higher, so it's great. And yet the data seems to suggest that they underperform over the long term.
The data is what we have. So just look at the data.
That's all we can go on. Yeah.
And these data, the last two slides I had up,
commission off of your purchase. So the data.
And these are Look at the fund performances for these. They have to legally provide them on their websites. You can normally see they might have brief periods of outperformance. Try to look at long term. Some of these are only a year or two old, and it might have a brief, it overperformed the market by 1% during this period. But then once it's existed for 5-10 years, that 0.6 to 1% fee is probably just going to eat that away anyways, even if they were able to match the index.
Excellent. Well, I think that's a good answer. And, I think that video should go around. And when anybody is asking about whether they should invest in a covered call ETF, they should watch that and look to see, what the data suggests in terms of performance over the long term. Yep. Okay. I think that's going to close off our show for this week. If you're watching me right now on YouTube, smash that subscribe button. If you're listening to this podcast, on iTunes or wherever you do consume your podcasts, rate and review us. Like I say, always positive reviews. That's what we're looking for. And if you've got a question that you want us answered, or your stock, our take, if you're looking at, again, any stocks that you think in this M&A environment that we're seeing right now might get taken over, send those in. We'll see if it looks like a potential takeover target. And again, I'd like to wish you profitable investing. Thank you.
All right. Thank you.
Thanks, everyone.
Thank you.